Welcome back to the latest. Now we go to the Federal Reserve. Janet Yellen is set to pass the baton to Jay Powell in just a matter of days. In her last decision as chairman, the Fed left interest rates unchanged yesterday. Joining us right now, the Gartman Letter editor and publisher, Dennis Gartman. Dennis, good to see you, sir. Thanks so much for joining us this morning.
Well, thanks for having me on.
Yeah, we're happy you're here. What was your take on the Fed yesterday, and what do you expect from the markets under Jay Powell?
Well, first of all, nobody was surprised by the fact that the Fed held policy steady. The only changes that were made were some very modest changes in the rhetoric of the post-meeting communique, where they indicated that the economy is stronger than had been anticipated, and that there would be further, which was just one word that they changed, further rate increases. I think that they're going to take the Fed funds rate at least three times higher this year, maybe even 4. The Fed needs to get the Fed funds rate to 2.5% or 3% over the course of the next year to year and a half in order for the Fed to have some powder on hand when the next recession, and there shall be a recession, does eventually hit. So the rates are going higher, not dramatically so, but they're going to be higher than almost anybody wants to anticipate at this point.
Dennis, it's Dagan McDowell. If bonds enter a bear market, I think we've had about a 40-year bull market in particularly government bonds. But if bonds enter a bear market and you do have yields going up, how can stocks survive that? So are we going to have these dual bear markets potentially?
Dagan, it's going to be very difficult for stocks to continue to rally in the face of, let's say, a 4% 10-year yield. There are times in the past when bond prices have gone lower, when yields have gone higher, and stock prices have gone higher too. That happens at the very end of bull markets. But before too long, if we get the long end of the yield curve another 100 basis points higher than this, it's going to be very difficult for the stock market to continue to rally. So I think you're in the last 10%, maybe the last 5% of the time value of a bull market in equities. You have to be careful from this point forward, no question.
Dennis, James Freeman here with the Wall Street Journal. Wanted to get your take on crude oil markets. We've had a lot of investors, particularly in this town, telling oil producers, don't drill so much, make profits, keep prices high. The producers have kind of said, okay, we'll learn this time, but they never really mean it. What are you expecting here? A lot more production this year in the United States?
I think we're going to be surprised how quickly we get. We've already gotten past 10 million barrels of crude oil. And let's remember, it was only several years ago that we were barely producing 4.5 to 5. The activity that's taken place with fracking, horizontal drilling, seismic technologies, we've become the most technologically advanced driller in the world. We've driven the price of production ridiculously lower. Almost any fracker worth any sort of capabilities whatsoever is able to produce crude oil at better than $25 and $30 per barrel, and you have a huge number of wells that have been drilled and are capped. So it's going to be difficult, I think, to let crude oil get much above, let's say, $62 to $64 WTI. At that point, there's the amount of hedging that will be established to protect prices going forward are going to be very large. I think from here on out, although I'm bullish on commodities generally, I think that the ability for crude oil to rally much beyond where prices are now is very, very limited.
But we should point out that Goldman Sachs is raising its Brent crude price over the next 3 months to 75. That's Brent. Dennis,
well, I wish them luck.
Yeah, Dennis, real quick here. If you're going to see rates go up, is there anywhere to hide in stocks? Are you expecting? So you say we're in the last 5 to 10% of a stock market rally because rates are going up. What do you want to buy? How do you allocate capital in the face of this? Real quick.
I think that cash is not such a bad place to be. One does not have to be fully invested all the time. I think the best place to be are high dividend paying shares. And if you make me buy something, make me buy the things that in real industrial activity, steel, copper, shipping, trucking, the things that even I can understand make sense to me. Would I hide in high tech? I'll let other people wiser than I do that. That's beyond my ken. Let me own the simple things. I think those are the things that do well in the tail ends of economic activity and the tail ends of bull markets.
Those areas that are tied to economic growth, I guess. Dennis, thank you. Well, good to see you, sir. Thank you so much. Dennis Gartman there coming up.
Thanks for having me on.